All right, we are recording. Scott, go ahead and take it away.
All right. Well, thank you again for the opportunity to chat with you all today. We're talking, as the title slide says, Oregon tax changes that everyone should know about. And I have been giving already a version of this talk for about 6 months now across the country. And Oregon, in many ways, it's our first topic. Oregon's playing some catch up with the rest of the country, but then with the Oregon corporate activity tax, Oregon's actually getting out ahead of the game. We do expect there to be a lot of changes from a tax policy perspective across the country over the next decade or so, and Oregon's adoption of the CAT is reflective of that. And then just some rules of the road as we're going forward. Please, 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 if you have a question as I'm rambling along, raise your hand, shout it out. Let's not stand on ceremony here, because I hate to give one of those talks where I ramble on for an hour or so, but don't really cover what you guys want to talk about. So don't hesitate to stop me in midstream, and we can cover on your specific issues. Our agenda today is fairly straightforward. First, we're going to cover Oregon's shift to market sourcing, and this applies to Oregon's corporate excise tax. As we all know, that's the Oregon Form 20. That's the tax on C Corps that Oregon imposes on C Corps that are doing business in the state. The Oregon corporate income tax is the tax that Oregon imposes on C Corps that are not doing business in Oregon but have Oregon source income. We all, I guess, default to calling it the corporate income tax, because that's really what the corporate excise tax is measured on. But that was a big change back in 2018. Then we're going to move to the second item. Probably the biggest topic for today is Oregon's considering a corporate activity tax. You can probably put that "considering" in quotes. You've been tracking this, you may think, well, wait a minute, I read about this, the legislature passed the law and the governor signed it. Well, as we'll talk about, the Oregon CAT is technically not yet effective law in the state of Oregon. And then we'll talk about the nuances there and some of the outstanding issues that remain to be addressed. We do expect 2020 to be a pretty big legislative year, even though it's a short session as far as the CAT is concerned. And lastly, to the extent we have time, I'm just going to talk briefly about the couple of tax changes in Portland that you may have seen. And these are mainly as exemplars of another trend that we are seeing across the country, that is local jurisdictions realizing that the states are not helping them fund all of their needs. So localities are looking to their own independent revenue sources. And Portland is no exception to that. We expect even larger towns, not even cities, to be adopting some of these kind of out-of-the-box taxes for a variety of reasons. And these are two good examples of the thinking that's going on out there. So without any further ado, let's dive into Oregon shifting to market sourcing. And this is going to apply for tax years that begin on or after January 1, 2018. And this was a situation where Oregon, in a way, was kind of late to the game. Market sourcing has been around for well over a decade, and a healthy plurality of the states have already adopted some version of market sourcing. This applies to, this is a corporate income tax concept for apportionment, where we're trying to figure out how much of a taxpayer's federal taxable income gets sourced to a specific state. And specifically, we are talking about how to apportion sales of items other than tangible personal property. And several years ago, the state started to figure out that market sourcing was actually a fairly beneficial methodology to adopt from a business retention and a business attraction standpoint. The old rule that is in the old MTC rules, Multi-State Tax Commission rules, was you applied a greater cost of performance methodology to determine how much of a taxpayer's sales of items other than tangible personal property should be sourced to a jurisdiction. Well, that made a lot of sense, when that rule was created back in the 50s, when the economy was drastically different than it is now. You kind of had to associate where you performed your service to where the economic benefit of that service was provided. There were some exceptions to that, but computers weren't really a thing yet. Telecommunications didn't get you very far. So most taxpayers that were service providers had to perform their services more or less in the same market where the benefit was delivered. That's obviously changed quite a bit. And so states figured out a while ago that if we go to more of a market sourcing basis, that can really attract service providers to do business in your jurisdiction. We say we're not going to increase the tax burden on you if you hire more people and make more capital investments in our jurisdiction. Oregon is the last of the West Coast states to adopt market sourcing. California and Washington have already done so. But Oregon is really heavily involved in the Multi-State Tax Commission, which promotes uniformity across the states. And once the MTC adopted a model market sourcing regime, Oregon adopted it very quickly. The problem is, as tax practitioners, some of you may know that the many states had already adopted market sourcing that's not consistent with the MTC model rules. And so while we're going to talk in some detail about the Oregon sourcing rules, we have to remember that these rules do not necessarily apply in other jurisdictions that may also apply market sourcing principles. So it's going to be and as we'll talk about, these rules are fairly complex. So we do have a lot of work ahead of us if our clients are in fact providing services or licensing intangibles across the country, because there could be lots of market sourcing jurisdictions on point. The old law, many of you should be familiar with this, where Oregon had a greater cost of performance approach. There was a very broad definition of gross receipts. Basically anything that produced business income was considered a gross receipt subject to apportionment. And then you sourced your sales of items other than tangible personal property according to where the seller's income producing activity occurred. And you measured that. If that activity occurred in more than one state, you measured that by looking at the taxpayer's costs of performance. And Oregon was a greater of cost of performance jurisdiction, meaning that the jurisdiction in which the taxpayer incurred the greatest cost of performance, more so than any in all the other states, then you sourced 100% of the associated service revenue to that jurisdiction. So if you take, for example, an accounting firm that was providing tax return preparation services for a nationwide customer, and 60% of its costs were incurred in Oregon, and 40% of its costs were incurred in California. And for a given batch of returns, they're paid $100,000, just to use round numbers. 100% of those sales would be sourced to Oregon because 60 is greater than 40. It's an all or nothing approach. And the idea used to be was that was fairly simple. That same rationale would apply if with that taxpayer, if it incurred 40% of its costs in Oregon, 30% of its costs in California, and 30% of its costs in Washington. Because 40 is greater than 30, Oregon, under a greater cost performance methodology, would get 100% of the associated service revenue. And again, when that model was created, taxpayers' business models, especially as service providers, it wasn't that complicated. And things have gotten a lot more complicated now with modern computers, telecommunications being what it is. I don't know if any of you have colleagues who work remotely, but I have lots of colleagues at Deloitte who never set foot inside a Deloitte office. They're either always out at a client site or they work from home. And those kinds of I see it a lot with our tech clients and a lot of our customers. It's fairly common in the business world now. And from a cost performance perspective, that can be a logistical nightmare. And then Oregon went and made things even more complicated with the recent Oregon Supreme Court case with AT&T, where Oregon said, you've got to apply this on a transaction by transaction basis. It couldn't look at just your overall operations for the year and lump all your revenues together. You had to look at each separate transaction and determine where your costs were incurred for that transaction. For AT&T, that was a single phone call. That could obviously be very difficult for AT&T to prove that out for every single phone call. And so in a bit of mercy, I'll go to the next slide, Oregon legislature finally said, okay, let's go to market sourcing. And so this applies for tax years beginning on after 1/1/2018, and we've left the cost performance regime behind us now. And in theory, the legislature thought that market sourcing was easier to apply than cost of performance. And while it may be easier for certain taxpayers, I think you'll see it's not going to be easier across the board. It starts out pretty simple. ORS 314665 subsection 4 now provides that sales of items other than tangible personal property are sourced to Oregon if the taxpayer's market is in Oregon. And market is defined in 314666. No irony at all to that code section name. And we're really talking about sales of intangibles and sales of services. The rest of this slide provides what the statute says about how you source sales of intangibles. And it starts by saying that the market is where the intangible is used. And then but then also provides some carve-outs where only certain sales of intangibles are included in apportionable income. And it's these two big categories here, contract rights, yada, 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 that allow you to conduct business in a certain geographic area. So a franchise, for example, would do business in a certain area, an ability to use intellectual property in a certain area we covered, or any kind of intangible property sales that are contingent upon the use or the productivity of that intangible. Those are treated as the rental, lease, or licensing of intangibles. Everything else is kicked out of the sales factor when it comes to sales of intangibles. So, for example, the sale of goodwill would
Sound just
not
went.
because. So, is there a question?
Your sound went away for a moment. Can you say that last sentence again?
Oh, so a sale of goodwill, for example, would not be considered an apportionable sale any longer because it is neither a contract right or any other kind of right that allows you to do business in a certain market. And it's not an intangible that's contingent upon the productivity or use of the asset. It's just an intangible asset that we all agree kind of exists. But it doesn't fit either of those categories. So the outright sale of goodwill would not be an apportionable receipt any longer. The income is still taxable income, of course, subject to apportionment. But let's say you had you were to have a customer that were or client that were to sell a business, and $300,000 of the deemed sale of good was allocated to, or the sale price was allocated to goodwill. Those $300,000 would not be included in your sales factor going forward because they don't meet either of these categories. The market sourcing regulations that we now, our statute really focuses on primarily on the licensing or rental of intangibles. That's what they're much more focused on. And to be honest, that's a more common business transaction now. We're more of an intangible-based economy than ever before, and there's lots of licensing. There isn't as much in the way of outright sales of intangible. There's tons of licensing of intangibles that goes on, and that again is focusing on where the intangible is used. And generally speaking, the statute says that, and the statute's written at a 30,000 foot level of detail. It says that you basically, it's where your customer is located is generally where it's going to be used. But as we're going to see in a minute, the detail is really provided in the regulations. The statute only gets you so far because defining where an intangible is used, it sounds kind of neat in concept, but when you start thinking about how to apply that in real facts that our clients are facing every day, it's much harder to apply that in practice, and that's where the regulations are going to come in.
Hey Scott, can I just provide some clarifying, because we're right now we're talking about sales of intangible assets. We're not talking about necessarily where services are performed or anything like that.
Yeah, services will be the next slide.
Okay, services. Okay, yeah. I'm just like, for people who maybe be unfamiliar about the difference between tangible, intangible assets versus services. I don't know if everybody. So it took me a little while to recognize that when you're talking about intangibles, we're talking about literally like franchise licensing fees,
Software as a service.
Those kinds of things. Yeah. So.
Well, sure.
I was thinking, like, at first I was thinking, oh, intangibles meaning nothing that's tangible. But we're talking literally about licensing and
streaming videos, phone calls,
rented license. Yeah.
Well, SaaS is actually a good. That's a nice wild card to bring up because SaaS could fit in a number of different categories. We're not going to talk about SaaS in detail, but SaaS in certain concepts is a service rather than an intangible because you have to look at what are you really paying for. So it's clear when for example, a franchise or the license of a copyright or the license of a patent. Those are very straightforward uses of intangibles. But in our modern economy, when if I download an app from somebody, is that person, do they sell me canned software? Do they sell me a digital good? Are they selling me a service? If they're providing hosted software, what is that going to be? And the rules do provide a certain amount of clarity, but there's still a lot of ambiguity baked into these rules that remain to be defined. So these discussions that we're having right now, as far as what are we talking about, that's the number one challenge that we face as tax practitioners right now, is being able to explain to the taxing agencies across the country that this item of revenue that we're talking about here is derived from a service or is derived from an intangible. And it can take a lot of explaining to the tax officials, the tax auditors, and the tax tribunals if it goes to an audit, what we're actually talking about here. And it's incumbent upon us as the advisor to go in and be able to explain that to the taxing agency. We can't expect the folks from the Department of Revenue or the FTB or any other taxing jurisdiction to be as up to speed on this as we are. So that's where, oh, go ahead.
So before we were talking about the other way of the majority cost, where the majority of costs were, we were talking about all income producing assets and services. So like Oregon previously, if you had a franchise where the franchise fee or intangible or software that was produced in Oregon, then it would mean that everybody, the company would pay tax to Oregon in Oregon, but the consumer wouldn't necessarily pay Oregon tax. And now this is like flipping that. Like, so now the consumer of the intangible or the intangible is now having to pay Oregon tax, or maybe the company is paying Oregon tax.
Yeah, this is how to source income for corporate income tax purposes.
Sort of for corporate income, and we're not talking about individual like businesses like S corps and whatnot either.
No, pass-through entities also calculate apportionment at the entity level, and then they figure out how much of their business income is sourced to Oregon, California, Washington, Idaho, you name it, and then those amounts flow up to the owners on a pro rata basis.
Would this be, is Oregon using market sourcing kind of allocation for that type of thing as well, or?
Yes.
Okay. Sounds like that's the next slide.
That's kind of what I was kind of curious.
Yeah, this applies to this apply. So if you were out there as an individual, where as a sole proprietorship, these apportionment concepts wouldn't necessarily apply. You'd have to get permission to apply those. It was more based upon where you're actually doing your business. But if you're doing any kind of a business entity filing, you're looking now at these apportionment concepts. So C corps, LLCs, taxes, partnerships, S corps. We're talking about these concepts here.
Okay.
Fantastic.
Sure. And so when it comes to sourcing sales of services, and just to be clear, we could spend 2 hours just on market sourcing today. I mean, these are incredibly detailed rules, incredibly challenging concepts. So we're hitting a bit of the high points today. Happy to answer any questions you have after the session, or you get my contact information. Of course, you can contact me then. I recognize this is a complicated area, but sales of services are sourced to Oregon, as the slide says, to the extent the service is delivered to Oregon. And again, this is the statute, and it's at a 30,000-foot level of detail. That's where the statute stops. It doesn't go any further than that. And so that's really not very helpful to us as practitioners or as taxpayers. And so, and Oregon knew that. And so they stepped in with very detailed administrative rules. You can see here the citation, OAR 150-314-0435. These regs are 16,000 words long. And what Oregon is trying to do with these regulations, and these regulations are consistent with the model regulations that the MTC adopted. So again, and California went to market sourcing before these rules were created, so California's rules are different. Washington State went to market sourcing before these rules were adopted, so Washington State's rules are different. But these are now similar to the model rules that are now in place that states can decide to choose if they want to. And Oregon's pretty consistent with those model rules. And these rules try to get granular by dividing up different kinds of services into different buckets and then giving you different sourcing rules that apply depending upon what bucket you fall into. And the first big bucket they create are what's the category of service that's being provided? Are they in-person services? Are they services delivered to a customer on behalf of a customer or delivered electronically through the customer? Or the third bucket, are they professional services? Those are the three main buckets they put these services into. And then the second criteria they use to help you figure out what your sourcing rules are what is your customer? Is your customer an individual or is it a business? And depending upon which bucket you fall into and who your customer is, what kind of entity your customer is, then you're going to have different sourcing rules provided for you in these regulations. And they've done a really good job, I think, trying to be comprehensive, but it's impossible to be completely comprehensive, right? So there are going to be lots of unanswered questions, even if you parse through these regulations. But as tax practitioners, the burden's going to be on us to know these broad categories, understand how they work, know the regs. The regs have lots of examples in them to try to help clarify how these rules get applied in practice. We're going to need to be able to make the best argument we can on behalf of our clients how their activity falls in these different categories. Just as an example, the next slide, this is how things work for professional services. I thought that might be of interest to this group. What's professional service? It's defined as any service of an intellectual or intangible nature, and then both legal and accounting services are called out specifically as professional services. And you might say, well, wait a minute, one of the other categories was in-person services. And I spend all my time meeting with my clients, providing an in-service, isn't that an in-service business or in-person business? And the regs and the DOR would likely say, well, no, in-person businesses are more like, a plumber or a hairstylist or anybody who has to physically be present at the location where the service is being performed. Even though you're always meeting with your clients, and you do a lot of in-person meetings, your accounting services are still more of a professional nature because of just the nature of the job. And so let's assume that we are talking about professional services. What are the sourcing rules that apply? If you have individuals who are your customers, so you're doing estate planning or something like that, or just personal income tax return prep, it's a pretty straightforward process. You have a two-tiered set of sourcing rules. And you start with the sourcing rule is you source all your revenues from that customer to the state of your customer's primary residence, if you know where that is. And that's your first rule. So hopefully for most of our individual clients, we know where their primary residence is. And you can see here, if you derive more than 5% of all your receipts from that taxpayer, you have an affirmative obligation to figure out where their primary residence is. If you can't figure that out, then you use the customer's billing address to source your revenue. So let's say you get paid $20,000 to prepare somebody's personal income tax returns and everything for them for the year, for their family. And you should know where their primary residence is. What state? If so, if you know it, then you source that full $20,000 would go into the sales factor numerator of that state. If you don't know where it is, maybe they divide up their time amongst their 5 vacation homes, and you can't figure out which one of those is their primary residence. You would then say, okay, we're going to go to the customer's billing address and source the $20,000 of revenue to the numerator of that jurisdiction. If your customer is a business customer, a different set of sourcing rules apply. And you see here, it's a 3-tiered set of sourcing rules. You start with the top tier, and it's the state where the contract of the sale is principally managed by the customer. What does that mean? No one really knows what that phrase actually means. But it sounds good, right? And so let's say you enter into a client with an engagement with the customer, and their mailing address is in Sacramento, California, but the tax team that you deal with, you work primarily with their tax team, and their CEO doesn't care about the tax contract. Their tax department does, and their tax department is in Medford. You would say, well, they are principally managing this contract from Oregon. So the revenue from that engagement would get sourced to Oregon, not California. If you don't know where that is, you can't determine where they are principally managing the contract, then you look to the state from where your customer placed the order. Hopefully that's a little bit easier to determine. And if you can't figure that out, then to the customer's billing address. So these are tiered sourcing rules that require you to do a bit of inquiry on your customers and answer these questions, but they try to get progressively easier the more you fall down on the hierarchy. As practitioners, we will need to be able to show the state if we can't meet the top criteria, why we couldn't, that we made a good faith effort to try, and then we had to fall down to the next tier on the sourcing rules. And just so you know, the Oregon Department of Revenue is going through training trying to figure out how to apply all these different rules. And this is all new to them too. And they're not familiar with how to apply these rules, but this is what they're trying to do. And then if you had, say, in-person services, you'll have a different batch of sourcing rules. If you have services delivered to a customer electronically or through a customer electronically, different sourcing rules apply. And that's why these regulations are 16,000 words long.
So Scott, one of our, of course, as bookkeepers and tax consultants, as we work with clients in other states, so the thing that started this controversy amongst us is, and not that we have controversy amongst us, but just with, oh my gosh, what's happening, is that so for instance, as a bookkeeper whose services, I work with my clients all remotely. I do have some local clients, but I have California clients. So am I now going to be obligated to California to pay income tax to California?
It's a great question, and unfortunately, I have perhaps some bad news for you on that front. Most states have adopted an economic nexus standard for out-of-state taxpayers to determine whether you have to file a tax return in that jurisdiction.
Right.
California tried to make it a bit more helpful by adopting what's called a factor-based nexus standard. So let's assume you never go to California on business, but you're providing a service. So Public Law 86272, which is a federal statute that protects sellers of tangible personal property from having to file different places, that doesn't apply. California were to say, if you have more than $500,000 of California sales, and that number's been indexed for inflation, so it's slightly higher than $500,000. I think it's closer to $600,000 now. If you have, let's say, $600,000 of California receipts, you are subject to California's corporate income tax, even if you never set foot in the jurisdiction.
Okay, but there is a threshold.
There is a threshold, but that is only one test. California also says, or if you are doing business in California. And that would mean if you ever go down to California to meet with your clients or to solicit sales, you are doing business in California, and that's enough to create a tax filing obligation for you in California, regardless of whether you meet the $500,000 indexed sales threshold or not.
But if I'm sitting on the phone in Oregon and we're negotiating a contract, I'm not really in California soliciting anything. I'm here. So,
Exactly. So if you physically never go into California to do business, then you are subject only to the factor-based sales threshold-based test.
So factor-based sales threshold, you said is $600,000?
Well, it's like 570,000 or something like that right now.
Right, but more than most small single practitioner firms are going to be yielding. So
right.
The whole thing that started this conversation was that last year, Scott, when I got my taxes done by my local CPA, because rules are constantly changing and I'm not a tax professional, my local CPA was talking about these rules that we're going through right now, and he said, hey, guess what? The laws changed retroactively going back to January 1st, 2018, and it's pretty clear from what he was saying that at this point, it's based upon the location of the customers. So I need a list of where all your customers are, basically sales by customer, and so that we can apportion out your income. And I had income in several states, some of which required a filing and some of which didn't.
Right.
So for the first time in 2018, my little LLC filing as an S Corp filed a state tax return in Utah and California, which then came through my 1120S to my K1, and I had to file a multi-state individual tax return. And
Yep.
the big thing was, as far as California went, because California and Oregon have a reciprocal agreement, I didn't actually owe any income tax in California, but California did demand that I pay their minimum $800 excise tax. And what my local CPA was saying was that, yeah, you're not going to owe any income tax in California. I did in Utah. I had to pay Utah of like $13. But for California, that minimum excise tax is one thing, but even if you don't owe tax, you're required to file the return, you're required to pay the excise tax, and that the penalty for a tax return that never got filed in the state of California is $150 per shareholder per month, and there's no statute of limitations in a tax return that never gets filed. So
Right.
5 years letting that go, that's $11,000. You know, that's the kind of mistake that can put a small business under.
And is that excise tax, does that only apply to, because Ingrid's an LLC, tax as an S Corp, I am an LLC, tax as a sole proprietor. So do I now have to be concerned that my CPA, who is different from Ingrid's CPA, didn't file any kind of an income tax return in California for last year?
And the longer California waits to hunt Joanne down, the more money they get.
Yeah, so like,
Well,
panicking.
but the question comes to mind: why though did your tax advisor have you file in California if you didn't meet that sales threshold and you didn't go to California to meet with your customers?
What's the sales threshold then?
It started at $500,000 back in 2013, I believe, and it was indexed for inflation.
That's for every small business. If you don't generate more than that amount of money as California source, then you don't have to pay. You don't have to claim that. You don't have to file. I just want to make sure we clarify.
Unless California otherwise says you are doing business in the state. So
Unless California says that you're doing.
Right, which I wasn't.
No.
I didn't go to California at all last year.
Boots on the ground kind of thing.
Right. Now this year, I taught at an accounting conference in San Diego and got paid all of $1,500 for it. So there's a big question, because I actually did get paid to teach a class in California.
Boots on the ground, yeah. You were there. Mm-hmm.
So that's going to change things for this year, but not for 2018.
the other issue to keep in mind, though, is that just because Oregon shifted to market sourcing in 2018, California had already been mandatory market sourcing since 2013. So that obligation predated Oregon's shift to market sourcing. So that issue was there when Oregon was a cost performance state. That issue, when California was there, the issue was there in Washington State too. Yeah. That's in market sourcing for several years.
Well, so if we're not meeting that threshold, I mean, part of me says if I'm gonna all of a sudden be responsible for excise taxes and everything to California, then I'm dropping California clients. But if I don't meet that threshold, it doesn't sound like I need to be making that kind of a decision and panicking and running away from all my California clients.
Yeah, if you are not doing business in California, and doing business is in quotes, that's an official determination based on your business activity in the state. But it generally means you're doing something in the state. Are you advertising in the state? I mean, what possible argument could California make that you're doing business there? Or do you meet the sales threshold? If either of those get satisfied, yes, then you have a California filing obligation. If the answer to both of those is no, then you don't need to file.
Hey, Scott, I've got a question actually. So for that sales threshold factor, if does it also include if the certain percentage of your sales is in California, then that also meets that threshold? So let's say you're not at 600,000, but let's say you're at 300,000, but 295,000 are California sales.
Yeah, if over 25% of your receipts are California receipts, if your sales factor is over 25%, then you're on the hook.
That might have been my issue for 2018 because the couple clients that I did have in California were some of my bigger clients.
Ah, okay.
So I'd have to look at it, but it's 25%. I'm gonna have to look at my reports when I get back to my
Yeah, that's a fairly consistent threshold that lots of states apply. Oregon also has an economic nexus standard, but it's just whether you generate significant gross receipts in the state, and they don't define what significant is. There's an administrative rule that says if you have 50 sales at $6.95 a pop, which translates to less than $350 of annual sales, that's not significant, which I respectfully submit is not helpful guidance for many taxpayers. California and other states have helped out by trying to adopt more of these bright line tests, make things a little more objective for everybody.
And yet, I guess you have to compare, even if you met the 25% threshold, I guess you still have to look at, okay, so I may be on the hook for an $800 excise tax, but how much income did I make? Might be worth the $800.
Right.
Right.
Then
All
I
right.
presume every state is different.
I say you presume every state is different?
Yeah, like if I have a client in Pennsylvania, is it going to be a different nexus?
Yeah, and if Pennsylvania is actually one of the few states that still requires a physical presence in Pennsylvania for you to be subject to tax there. Most states have adopted some kind of an economic nexus standard.
Great, thanks, Pennsylvania. So, well, and I guess for my tax accountant, what he was saying was that, yes, California had the market sourcing in place long before Oregon, but it was when Oregon changed their rules to be more similar to California's rules that Oregon's old rules stopped protecting us. And it started to become based upon the location of the customer rather than the location where the work was done.
Well, the Oregon protecting you, I think, was the protection in that. I think that he was invoking the reciprocity agreement between the states, where you, as you said, you didn't owe any actual California tax because of the way the tax credit works for taxes paid to another jurisdiction, and how the states have worked that out. That doesn't change the fact you had a filing obligation.
So there was a filing obligation in California previously as well because of California's rules of market sourcing.
Yeah, between California, if you meet California's nexus tests, California's has had market sourcing now for several years.
Well, you know, like
And just to follow up on that, it's not like individual income tax, where on the business side you get credits for taxes paid to other jurisdictions. When you're talking about apportionment, sales can be sourced to multiple states. I had a number of Oregon-based clients where their overall sales factor was well north of 100% because they were sourcing 90 to 100% of their overall sales to Oregon because they were based in Oregon, but they also had nexus with several market sourcing jurisdictions and were sourcing sales there as well.
Okay.
And what protection is there for say in my case, if California came back a couple years from now and said, oh, well, you were supposed to file, but my CPA told me that I didn't have to file. Is there protection for the taxpayer?
You would have, if you have correspondence from your tax advisor saying you don't have to file, you have an action against your tax advisor, but there's not much protection from California. Now, I don't expect California to be aggressively kicking the tires on when you should have been filing. Usually when you file your first return in the state will ask, well, when did you start doing business here?
Okay.
No, until you file a return, the statute of limitations does not run. If you identify a jurisdiction, let's say you hadn't filed in California yet, and you figure out that, well, maybe I should be, and you have your advisor look at it, and you determine, yeah, I should have been filing in California the last 6 years, then you can look into what's doing a voluntary disclosure. where you come clean with the state and say, hey, look, you haven't caught me yet. And you do this on an anonymous basis in most states. And you say, well, you haven't caught me yet, but I'm going to come to you and tell you, look, this is my, I should have been filing in California a while ago. Here's my exposure. Can we make this right? They will limit your look back period usually to 3 years, and they'll waive any penalties for failure to file. I don't think California is trying to balance the budget on the backs of tax advisors and small businesses such as you're talking about. That's more of a situation where they're more focused on bigger companies that haven't been filing where they should be. But if you were to determine that you actually had a historic filing obligation and you haven't yet been contacted by the state, that's the voluntary disclosure process is the way to take care of that.
Okay, thanks, Scott.
Okay.
Moving on from market sourcing, and thanks for the questions. These are great. And I've been looking at the clock. How are we doing on time?
We're doing fine. We have we have until 2 for the meeting. We like to take the last 10-15 minutes for Q&A and networking and things like that. So, but we've got probably as much time as you need.
Okay. Well, I'll try to keep things moving. So, feel free if you need me to speed things up, just let me know. But now we're going to shift gears and talk about the Oregon corporate activity tax. And this tax, I'm sure you guys followed it in the legislature this year. This was the biggest single issue that the Oregon legislature dealt with until they tried to get the cap and trade bill in place. But this is a brand new tax on top of all of Oregon's existing business taxes. And it's been put in place it's designed to fund education, K through 12 education, specifically in the state of Oregon. Extensive hearings were held. And unfortunately, the legislature was primarily concerned with the politics of this tax. As a result, there are many unanswered questions from a tax technical perspective, but it looks like they've gotten the cat through the danger zone, and it looks like this tax is going to go into effect. And what do I mean by that? Well, in Oregon, as you may know, anytime the legislature passes a tax law, the legislation will say towards the end that the legislation does not go into effect until the 91st day after the adjournment of the legislative session. And that provides under the Oregon Constitution a period where signatures of Oregonians can be submitted to the Oregon Secretary of State. And if sufficient signatures are submitted, then the tax law gets put on hold, and the tax law that was enacted goes to basically a veto vote or a ratification vote, depending on your perspective, of the Oregon voters in the next statewide election. And you may remember the Grand Bargain, I believe it was called, back in 2008, 2009. We had a big personal income tax increase and a big corporate income tax increase in 2 different bills. Those were both sent to the Oregon voting public as measures 66 and 67 because sufficient signatures were submitted. The Oregon legislature was worried that that same thing was going to happen. Measures 66 and 67 passed, but the legislature was worried they're going to go through all this effort to create this new tax, and then the Oregon voters would just repeal it. Mainly because there's this, as you'll see, this is a modified gross receipts tax, and the word has gotten out before when Oregon's looked at a gross receipts tax in the past that a gross receipts tax is a sales tax on steroids. And as we all know, we Oregonians fear a sales tax above all things. And so we are, unless it's imposed on marijuana, of course, but they were afraid they'll go through all this effort to pass the tax, and then the Oregonians would reject it as a sales tax. After this tax was passed, the law was signed by the governor. There was a signature drive initiative kicked off. I think it was by a group called Oregon Manufacturers and Commerce. They had $1 million war chest. It was expected they were going to get the 75,000 signatures necessary to send this to a vote. But that effort has died. That's no longer operative. I think they got a hold of some polling data that said that this was going to pass regardless of whether they got it on the ballot or not. So they pulled the plug on it. There is no ongoing signature gathering effort to send this to the Oregon voting public. The 91st day, though, after the legislative session is September 29th. So technically, this law has not yet gone into effect. If any of you hate this tax, you can go out and gather signatures and send them to the Oregon Secretary of State. You've got time. I'm not sure you'll be able to pull it off in this little time, but as an academic matter, we're still in this 90-day period where this law has not yet gone into effect, even though the governor signed it months ago. But this new tax, it's designed to raise $1 billion a year net in revenue. And they did it by calling it the corporate activity tax. And it's a bit of a misnomer because it does not apply just to corporations. It applies across the board to virtually anybody who's engaged in business in the state. If you look at House Bill 3427, that was the first bill they passed. It's got a ton of legislative requirements in there, basically saying how they're going to spend the money once they get it. Only the last third of the bill actually talks about the revenue component to it. In broad strokes, there is it's probably going to raise about $1.2 billion a year, but there's a slight personal income tax rate deduction where the bottom three brackets for Oregon personal income taxes are all going to get cut by 0.25%. So if you are an Oregonian in the top Oregon personal income tax bracket, you will save $312 a year. That's to offset what the legislature projects to be a slight increase in prices we will all pay as businesses start passing through this CAT to their customers. In broad strokes, the CAT is imposed at the rate of 0.57% on a taxpayer's taxable commercial activity in excess of $1 million. If you have taxable commercial activity of less than $1 million, which are receipts sourced to Oregon, then you're exempt from the tax. If you exceed that threshold, you have to pay a flat tax of $250 on the first $1 million of Oregon sales and 0.57% on all your Oregon sales above and beyond that threshold. The tax is imposed on both single taxpayers and unitary groups of taxpayers, which they'll treat as one taxpayer. We'll talk about that in a little more detail. And then every taxpayer gets one subtraction. It's equal to 35% of the greater of either your compensation or your cost of goods sold. We'll talk about that in a little more detail going forward. Are you all familiar with this tax, or is this news to anybody this has come out?
It's news to me.
Yeah, news to us.
So this is different than I thought there had already been a sale. This is the one that we've been waiting for.
This is
Is this the one we've been waiting for?
This has been in the
Okay,
works
so there
for a few
hasn't
months.
been.
Yeah,
one
I
that's
remember
been
seeing it
in.
on the ballot.
I know that the 1 million was. I thought there was like a 20. I thought there was one for like 25 million or something like that. But, can I ask you a question real quick though?
Sure.
Like with the market sourcing, we didn't talk about tangibles though. Like, so say like we have all these hemp farms, for example, and all the products being bought out of state. They still pay Oregon tax, or?
Well, the sourcing of sales of tangible personal property has not changed for the corporate income tax. That remains. So that's basically on a destination basis, unless you are not taxable in the destination state, in which case you throw the sales back to the state from which you shipped the product. So if you were selling widgets from Medford, from a distribution center in Medford, you sell $10,000 of widgets to someone in Ashland, and you deliver it to their destination in Ashland, then those are $10,000 of Oregon sales. If you deliver it across the border into California, if you are filing a California income tax return, those sales will be California sales. If you're not filing a California income tax return, you're saying that you don't have Nexus down there, then those sales get thrown back and they are considered Oregon sales. And that did not change when these market sourcing rules were adopted.
Right.
So here's a little more detail on the CAT. A taxpayer is any person or unitary group that's required to register, file, or pay the Oregon CAT. And you can see your person is basically anybody or anything. Individual is a person. A joint venture is a person. A disregarded entity is a person. A trust is a person. Okay? And a unitary group is any common group of persons unified by a 50% ownership test that constitutes a unitary business. And that's, basically any business with the standard unitary business tests. You've got centralized management, you've got economies of scale through centralized administrative services, and you've got functional integration demonstrated through your flow of goods, capital resources, et cetera, et cetera. And this is one of those situations, though, that it's generally a good thing to be in a unitary group. And we'll talk about that in just a second. That's a pretty loaded slide. Does anybody have any questions on that slide before we move on to the next slide? We'll get into the registration requirements and stuff like that later. So this corporate activity tax is actually not imposed not on corporate activity, but on commercial activity. Well, why do you ask? They call it the corporate activity tax when they could have called it the commercial activity tax. The official reason is that Ohio has a commercial activity tax. Therefore, the name was taken. We can't use that. That answer does not hold up. This is an example of where they were worried about this going to a vote of Oregonians. And they thought, if they call it the corporate activity tax, it will be easier to have Oregonians think, oh, this is a tax on big business. I'm fine with them paying it, the money going to education. So the odds are they would vote in favor of it rather than commercial activity tax. What is that? Oh, that's a gross receipts tax. I don't like that because that's a sales tax. And that's what they were worried about. So that's why it's based on commercial activity. And basically it applies to gross receipts of any person from transaction activity in the regular course of your trade or business. And you get no deductions for your operations and stuff like that, except the one subtraction we'll talk about in a minute. So your gross receipts, but then there's a whole bunch of stuff that's excluded. And this is only a partial list. There's a bunch of things that get carved out. And you see here, there are lots of big exclusions from sales, from taxable commercial activity here. You mentioned hemp farms earlier. If you scroll down to the bottom here, you'll see receipts from the wholesale or retail sales of groceries. They House Bill 2164 was a technical amendments bill that they passed after they passed House Bill 3427. That clarified that edible cannabinoids are not groceries. So if you're selling a lot of hash brownies, you can't claim that those are exempt from the tax as groceries. Groceries are defined as sale of food for home consumption. Restaurants, that's not, if you have a client that say is a food wholesaler and they sell food to a restaurant, that's not an exempt grocery. If they sell to Fred Meyer and Fred Meyer is going to sell their product over the counter, that's an exempt grocery. That's not subject to tax. But dividends are excluded. Distributive income from pass-through entities, that's excluded. Receipts from members of the unitary group, intercompany receipts, those are excluded. Hedging transactions are excluded. Receipts from 1221, 1231 assets, those are excluded. So there's a whole bunch of exclusions here. But this tax is going to raise $1 billion. So there are still plenty of taxable receipts left, but there are some broad categories here of exemptions. Motor fuel is exempt, but electricity is not motor fuel, even if you drive a Vesta. And again, the list of exemptions, I think, goes from A to double Y. I think there's a whole bunch. Most of them are really small. There are things like, oh, sure.
How clearly, in the legislation, how clearly did they define education? I mean, is it really going to be seen in the classroom, or is this going to be gobbled up by the PERS program?
Well, that's one of the big questions that was being addressed is by the legislation, it will not go into PERS. The problem is that this is something that some folks who are in the Republican side who were basically shut out of the process legislatively because the Democrats have a supermajority in the legislature. They didn't need a single Republican vote. So it's kind of the flip side of what we saw in Congress when they passed the Tax Cuts and Jobs Act, where they didn't get a single Democratic vote. It didn't have any hearings or anything like that. At least the Democrats held a lot of hearings, but they didn't need to get a single Republican vote to pass the Oregon CAT. But one of the arguments that was made by the Republicans, some of the Republicans, was, well, this CAT, how it's going to be spent, that's just the statute. You could pass a different statute next year that says we're going to take $300 million just this once and put it into PERS, and then you renew it, and then you renew it. Before you know it, all this money that we're raising ostensibly to fund education is not going into education, it's going into PERS. Now, the Democrats will say, no, we've staked our credibility on not reallocating these funds and putting it in education. We'll get voted out of office if we break these promises, so we're not breaking these promises. I will let you conclude how reliable a politician's promise is when money is concerned and how to spend it. But they would have to pass a law to take the money out. They couldn't just put the money into a fund and money's fungible and all that stuff. They got it's been earmarked, but the earmark can be changed by legislation.
Yeah. Okay. Thanks.
Sure. Taxable commercial activity, and the tax is imposed not on commercial activity, but on taxable commercial activity. That means commercial activity that's sourced to Oregon. So if you have sales that you're making to California customers, that's not going to be taxable commercial activity because that's going to be sourced to California. Here are the sourcing rules that get applied. If you're selling real estate, easy enough. Where's the real estate located? If you're selling tangible personal property, is the property located in Oregon or shipped to somebody in Oregon? If so, then it's a taxable gross receipt. Services. Is the gross receipt sourced, or it's sourced if the service is delivered to a location in Oregon? It's the same statutory standard that Oregon has now for the corporate income tax that we just talked about. Same thing for intangibles. Sourced to Oregon to the extent the intangible is used in Oregon. Special rules for financial institutions and insurers. These need to be defined because right now it only says they're sourced to Oregon if the commercial activity is from business conducted in Oregon. There's nothing that defines what that means. So we need rules to come out here. And then if any of these rules don't fairly apply to your revenue streams, you can always ask for alternative apportionment, an alternative sourcing method. Just so you know, right now, those 16,000 words of market sourcing regulations that we just talked about for the corporate income tax, they have not yet been officially applied to the CAT. The expectation is they will. They just haven't done that yet. But that would take a separate legislation. It's probably going to happen in 2020. But this tells you how to source your receipts to Oregon for CAT purposes, the same concepts that we now use for corporate income tax purposes.
So with that, given that we're talking about the corporate activity tax, being in essence kind of like a sales tax, that brings up another big question that came up during our discussion with Avalara when they were giving us a product demo and talking about some of the big changes with Wayfair and Nexus and those kinds of rules. With these apportionment ideas in mind, if there is a state where they charge sales tax on accounting services and the apportionment is to the extent where we might have to file tax in that state, would we be required to collect sales taxes on our accounting or business strategy services for that state?
Yes, if you have Hawaii clients, if you have New Mexico clients, that's something that we'll need to worry about.
So how do we find out?
The good news is most states don't impose sales tax on accounting services.
But
Hawaii is one of the few exceptions. Hawaii imposes sales tax on everything. They just do. It's the name, but there's such a unique economy. They kind of have to,
right.
And it's such a high cost jurisdiction anyway. They feel like they can go after basically anybody. If you're only in Hawaii because you want to be, right? Even as a business, no one has to be there. And
There's a
so
lot
they
of
feel like,
accountants in Hawaii that live in Hawaii.
Yeah, but not a lot of accountants who specialize in tourism activities, and guess what Hawaii has a lot of? So yeah, is there a way for us to find out specifically which states we might need to look into? Because that was a question we posed to Avalera, and they never got back to us.
I would say as a threshold matter, you are worried about the gross receipts tax states plus Hawaii. So gross receipts tax states, those are few and far between. You have Washington State, you have Ohio, you have New Mexico, and Oregon's a modified gross receipts tax state. And obviously we're not worried about them. That you're getting pretty close to the end of the states that have a gross receipts tax. There are a number of cities that are starting to add their own gross receipts tax, like San Francisco now has two gross receipts taxes. We're looking at adding a third.
So if we have clients in San Francisco, do we need to worry about the local level as well?
Yes.
Yes, you're sourcing.
Wow, what a pain.
I know Portland like that.
This is why I have a job.
Oh.
Okay.
Wow.
Well, go ahead and continue, Scott. I want to make sure we're able to get through all your slides.
Well, I can just tell this will be the last time you all want to hear from me, so I'm going to thank you now for the opportunity to present to you today. But let's talk back to the CAT. We have the subtraction. You're entitled to one subtraction, and this is a big enough deal. Our unofficial position at Deloitte is that this tax, because of the subtraction, this is covered by ASC 740, not ASC 450, which ASC 450 applies to non-income taxes. ASC 740 applies to financial reporting for income taxes. But you take the 35% of the greater of either your cost inputs, which is your COGS, cost of goods sold, or your labor costs, which is your total compensation of all your employees, capped at $500,000 for any single employee. So to put this in, to demonstrate how that last one would work, how that cap works, let's assume there's a company with 10 employees. You have 9 employees, each making $100,000 a year. The 10th employee makes $10 million a year. Their compensation subtraction would be $1.4 million. 900 grand for the first 9 employees and $500,000 for the 10th employee. You can't use the excess of $900,000 for each of the first 9 employees to get to deduct part of the 10 million for the 10th. It's $5 million, or it's $500,000 for each individual employee, and that's only employees. So you don't as of right now, any payments you make to an independent contractor or an agent, your 1099 payments, those don't qualify. It's just W-2 wages at this point. And then you have to apportion that subtraction, and that's done using your corporate income tax sales factor. This is something that is going to get a lot of attention going forward because it's a pretty complex calculation, and the Department of Revenue isn't sure how they're going to apply it. But just if you're doing a lot of business in Oregon and you have a high Oregon sales factor, this is a good thing for you. If you have a very small Oregon sales factor, you shouldn't worry about this subtraction too much. But since y'all have presumably all a decent size Oregon customer base, this would apply to you. The subtraction cannot exceed 95% of your taxable commercial activity, and the subtraction comes off of your taxable commercial activity. So it's your Oregon sourced receipts. And so that subtraction may be enough sometimes to pull you down below that $1 million threshold. So you become exempt from the tax. For the right taxpayer, the subtraction is quite meaningful. The Nexus standards that Oregon uses for the CAT, I mean, we're all of us on the call here are Oregon practitioners. We're all already on the hook for Oregon taxes. If you were talking to somebody, in California, and they say, hey, what do I have to pay this Oregon CAT? Do I have to register and pay for it? You can say, well, do you do any of the following? Do you own or use capital in Oregon? Are you authorized to do business with Oregon through the Oregon Secretary of State? Do you have bright line nexus, which is similar to what we have with California, either a $50K of property or payroll in the state or $750,000 of commercial activity in Oregon, or are your factors in Oregon greater than 25%? Or do you have nexus with Oregon sufficient to create nexus under the U.S. Constitution? If any of those are true, you have nexus, you've got to file. At least register with the state. That's a funny standard because really only the bottom one is sufficient. Nexus, you've established a presence in Oregon sufficient to create nexus under the U.S. Constitution, because if any of the other standards aren't sufficient to create nexus with Oregon under the U.S. Constitution, then the Constitution wins. So, but there is that bright line test. Just you want to make sure if you talk to anybody out of state who's asking you questions about this, tell them don't get too caught up with the bright line test, because that's just one test. There are other tests that can apply that can bring you into Oregon's welcoming taxing arms. So you want to think about that as well.
So can I just, if we could repeat the exemption, you can subtract 35% of the greater of either COGS inputs or labor costs. Okay. I mean, I just had to reread it a little bit.
Answer
I
question.
got it. Yeah, I just answered that question.
Okay.
So yeah, let's put things in explicit terms. If you had $200,000 of compensation in 2020, which would be the first year this tax will go into effect, you would have, and that's your gross compensation, your total compensation paid. Your subtraction will then go down to $70,000, 35% of $200,000, and then you would apportion that $200,000 using your Oregon sales factor. So if your Oregon sales factor was, say, 60%, your subtraction would be $120,000. I'm sorry, no, not sorry. No, it's not. It would be 60% of $70,000. So it'd be what, $42,000? Yeah. So it still can be a decent subtraction, but you can see the importance of the Oregon sales factor in calculating that.
Okay.
Registration, taxpayers with commercial activity exceeding $750,000 must register with the Oregon Department of Revenue for the CAT. Now, it's important to note that's commercial activity, not taxable commercial activity, which is a ridiculous test, because that means that if there's a restaurant in Hoboken, New Jersey that has $1 million of sales in Hoboken, Oregon thinks they should register with Oregon for the CAT. Clearly, they don't have to. So you have to have Nexus first. But you can see here, Oregon is trying to set a very low bar for registration. And that's kind of important because the penalty for failure to register can run up to $1,000 a year. So Oregon really wants you to register. Even if you're an exempt taxpayer, they want you to register. And then if you have commercial activity and you're doing business in Oregon, you have commercial activity in excess of $1 million, you got to file a return, and then quarterly payments are required. They're trying to get those teed up to be estimated payments, but it's a calendar year filing. It's not it's not a fiscal year. I don't know if any of you file your corporate returns on a fiscal year basis, but if you do, as of right now, you cannot file the CAT on a fiscal year basis. Now, people are talking to the legislature and say, look, you should allow taxpayers the election that if they file their corporate income tax returns or their partnership returns or any other returns, on a fiscal year basis, allow them the election to file the CAT on the same fiscal year. I think the legislature is going to see the light on that, but that's not yet officially in the law. So as of right now, everybody's got to file this on a calendar year basis. One of the more controversial provisions in the CAT legislation was a local tax preemption provision that said that no local jurisdiction in Oregon can impose basically a gross receipts tax. This does not preempt the Portland gross receipts tax that some of you may be familiar with, because that's grandfathered in. But if Medford were to say now try to do their own commercial activity tax, a local version of it, that will be preempted by the Oregon CAT legislation. It's also important to note this is imposed, even though it's kind of talked about, it's kind of like a sales tax. This is imposed on the taxpayer generating the gross receipts, not the customer. If you were to look at this and say, well, shoot, I'm going to help, help me pay this tax, I'm just going to add 0.5% surcharge to all my invoices to help me pay for this. And even if you separately state that on your invoices, that's going to be a taxable receipt as well.
Quick question. So where it says the local tax preemption, it says that we can't impose a tax on commercial activity or on receipts from grocery sales, but you said gross receipts.
Well, that's what I mean by commercial activity. I meant gross receipts.
Right, but there it says grocery sales specifically?
Yeah, those what they don't want is for local jurisdictions to create a new gross receipts, or basically a new sales tax that would do an end run around the exemption for groceries.
Okay. Great. So the gross receipts just kind of gets lumped into the commercial activity. I wasn't sure if maybe there was a typo in the slide. Maybe like
No, there may be, but they're not in that one.
if you say gross receipts and she heard grocery receipts or something, I'm like,
got it. Oh, the one exception is that there is a provision that says that vehicle dealers can collect the tax from their customers and it won't qualify as an additional gross receipt. That only applies to vehicle dealers, and that's pretty narrowly defined.
I have a question real quick too.
Sure.
In the compliance there, it says that you're subject to the tax if your commercial activity is $1 million or more. Is that one taxable commercial activity or?
No, that's just commercial activity. So let's say you had 1.2 million of commercial activity in the year, and it was split equally between Oregon and California customers. You'd only have $600,000 of Oregon taxable commercial activity, and that's pre-subtraction, obviously. You would still need to file an annual return, but it would be a zero tax due return.
Okay, got it. Thank you.
What Oregon really wants is for everybody to be giving them paperwork, so they know everybody who could theoretically pay this tax, so they can go after people easier.
okay.
There is a temporary provision. One of the concerns was that this was going to this CAT was going to inflate housing costs by increasing the price of new residential housing, and so there is a short-term exclusion for certain subcontracting payments, where subcontractors get to exclude a portion of their payments from general contractors, but only if they're working on single-family residence homes in Oregon. There's some confusion as to whether the sub or the general gets the benefit. My reading is that the subcontractor gets the benefit, and then the general will get the indirect benefit of the sub will then not add this tax, to their invoice. That's a lot of folks thought that was not going to solve the problem of affordable housing in Oregon, and so housing is probably going to be one of those areas where you hear some more squawking around potential legislation, but that's what's gotten in there so far. And then you may have heard there is a use tax component to the Oregon CAT. We'll probably have it, but this is one where Oregon likes to cut and paste things from other states, and this is something that they cut and paste from the Ohio commercial activities tax. As a good friend of mine who works for the Council on State Taxation said, the Oregon CAT is what would happen if the Ohio CAT and the Texas margin tax met on Tinder and made a mistake. It's really it's a mashup of those two taxes. And the Ohio CAT is a gross receipts tax that is filed, the default methodology is filing on a separate company basis. You can elect to file consolidated, but the default method is to file separately. And what Ohio was worried about is there are a bunch of distribution centers just outside of Ohio, and they are worried that a related party related party A would make sales from outside Ohio to related party B in Ohio, but instead of shipping it to Ohio and creating Ohio gross receipts, they would ship it to a distribution center, say on the Ohio-Kentucky border, but on the Kentucky side. And then the Ohio-based customer, so it'd be a Kentucky sale, not subject to the CAT, and then the Ohio customer would then go over to Kentucky, pick up the widget, and bring it into Ohio, and thereby avoid the CAT. So Ohio put this use tax concept into the legislation. Oregon just copied it, not understanding that it's kind of irrelevant because we have mandatory unitary filing. So that related party transaction between A and B that I just described, that's eliminated anyway from the CAT calculation, so it's not taxable. Also, there aren't massive distribution centers right outside of Oregon where anybody sends anything to get shipped into Oregon from California. It'd be kind of crazy to ship stuff to California to then get brought surreptitiously into Oregon, because California's a higher tax jurisdiction. Same thing with Washington State with the B&O tax. You wouldn't do it there. And then there's really nothing on the Idaho-Oregon border where to speak of, so you wouldn't do it there either. So this is really a provision in search of a problem. This has been pointed out to the legislature. They're probably sticking with their guns, but the concern is you give the Department of Revenue a stick, they're going to try to whack taxpayers with it. There is an effort to try to get an elevated threshold met where the state has to prove that there's a tax avoidance purpose as a threshold matter before they can even make the argument that this use tax applies. Because right now there really is nothing that stops the DOR from just saying, well, yeah, we think this applies too, without really providing any affirmative evidence to support that. And so we're trying to get some brakes put on the DOR and their ability to apply this test. We don't know if we'll be successful in that effort, but the concern is that the DOR might take this use tax provision out and apply it in situations where it really isn't warranted, just as another stick to whack a taxpayer with. But that brings me to the end of my whirlwind presentation of these taxes. I did say at the outset, I was going to talk briefly about Portland. Portland is a bit of an exemplar in that the city, I don't know if you've been to Portland recently, but there are lots of unmet financial needs that the city is trying to meet. And they're trying to do this in a couple of different ways. One is there is a new CEO surcharge. Portland imposes a business license tax on all businesses doing business in the city. If you are a publicly traded corporation and your CEO, per your 10K, has a pay ratio that exceeds 100 to 1, you have to pay a surcharge of 10%. If your published pay ratio exceeds 250 to 1, you got to pay a 25% surcharge. And it's kind of a public shaming concept because the whole tax is only going to raise about $2.5 million a year. So it's not a real big dollar hit on these big companies, but it's a way that Oregon is trying to raise some more money for the city from companies that they're saying, well, they can pay their CEOs this much, they should be able to pay us a little bit more. A bigger issue is the Portland voters in 2018, so this is effective in 1/1/19 going forward, approve via ballot measure the clean energy surcharge. And this is a gross receipts tax on large retailers, meaning any business that has more than $500,000 of retail sales in Portland and $1 billion of retail sales everywhere. If you meet that criteria and you pay Portland business license tax, you owe a 1% gross receipts tax on your Portland sales. I throw this out there not that because it's going to affect you and your clients, but because cities and counties up and down the West Coast are thinking about ways to raise revenue to fund local concerns that the state is not helping them meet. We're seeing this a lot where there's a local need and there isn't support at the state level to get more funding allocated to fund that local need. So the city or the county is looking at doing that themselves. Traditionally, you had things like hotel occupancy taxes and other taxes imposed on tourism. Localities are thinking more broadly than that. The city of Mountain View, California has imposed a head tax on basically larger employers in the area. And lots of local jurisdictions are looking at that. It came up a lot in the legislative hearings on the CAT with this preemption issue that lots of local politicians, mayors, people in city councils, county officials were coming to the state and saying, hey, just so you know, we were looking at adopting something like this. You're kind of tying our hands by saying we can't do this kind of tax. The state didn't care, but assuming those folks were being sincere, that they were looking at local tax issues, and somewhere from Southern Oregon, you may want to be monitoring what kind of city and county tax proposals are being made or being considered, because you may want to weigh in on those earlier rather than later.
Got it. Well, thanks so much, Scott. This is all fascinating information. I do want to acknowledge that it is 5 minutes past the hour, so if anyone needs to get going, we want to respect your time. As far as if anyone has any questions, how are you doing on time, Scott?
I've got time, I think. Let me pull. And thank you for bearing with me. I know I can get a little long-winded, so I appreciate your
That's
patience.
amazing
Thank you so
information.
much. I'm going to take off because we got some e-filing
Yep.
and some tax returns that are still.
Thanks so much for coming, you
All
guys.
right.
Nice
guys.
meeting
And
you
we'll
all.
kind of continue the conversation in the Facebook group if there's
Yeah.
additional
Yeah.
information and such like that.
Thank you.
Yeah.
The
Thank you
Appleware
guys for.
website?
Thank you so much,
Thanks.
Scott.
Yeah,
It's
thank
great
you.
presentation.
Thank you. Enjoyed it.
So we do have a few people going. Scott, I do have another question for you, just to try to get total clarity on my own situation. So
Okay.
as an LLC filing as an S corp, that was well under that 600,000 threshold in 2018. Was I required to file in California?
Well, that's going to, unfortunately, the doing business test in California is very subjective. So but one of the questions would be, how do you generate your California customers?
Word of mouth. They hear about me from, other of my clients, or maybe I met them at a conference. So I spoke at a conference in Las Vegas. I've spoken at a conference in Wisconsin. There's
No targeted advertising in California, no business trips to California.
Advertising.
Yeah, you're probably okay, because you're probably then not doing business in California as far as establishing a physical presence is concerned.
Okay.
Just be warned that it's a very low bar. So if you fly to that conference in Vegas and you go through San Francisco airport, you're probably okay, but don't take a business call while you're in the airport, waiting for your transfer. So you are probably okay. I hesitate to get too declarative, because
right.
it's always facts and circumstances driven, but you want to be able, if let's say your customers are kind of divided between, 4 or 5, a handful of states. Every year you're going to need to evaluate, do I need to file in these jurisdictions?
Which is such a pain.
What's that?
Which is such a pain that we have to do it that way.
Exactly, and it really is. And Oregon it's good that you're physically based in Oregon, because Oregon is as aggressive as it comes when it comes to applying economic nexus standards. They are incredibly aggressive. There are other ways that states look at establishing a taxable presence. So if you were to have any kind of other business down there making referrals for you, and you're making any kind of they get any kind of compensation for that fact, that then the state would say, no, you got an in-state agent, soliciting sales on your behalf, building out your market on your behalf. The states are all very, very aggressive when it comes to trying to bring taxpayers into their welcoming taxing arms. Now, they're not going after small tax practitioners as an industry, because they know no matter what, you're not a huge source of revenue for them. So you're not on a prime, audits, list of top 10 offenders or anything like that.
Right.
So you're probably pretty safe, and you're probably flying under the radar.
Well,
That being, that your fault, but also if you're signing returns, if I remember signing a return in a jurisdiction, I'm thinking, well, the state now knows about me, and they could put me, if I'm filing a return for a California return, they could just look at my name and say, well, is this person filing in California? That's a question.
How about if we're getting a 1099 from a California company?
That puts you on the radar as well. Now, if you're doing all of that work outside of California, and you can say, you've never gone into the state, that's really helpful. But
One
those
trip
kinds of
to
filings,
camping.
what's that?
One camping trip to the Redwoods and you're
And I took a business call.
If you were talking taxes in the Redwoods, that was going to be the quietest campsite probably within 50 miles. So it's something that you would likely trigger which you would likely get as a Nexus questionnaire from the state. And under penalties of perjury, you got to fill that out saying exactly what you've been doing. And in the state, if you can say, look, I've got my only presence is I've got some customers in California that I've never solicited sales in California. I have no advertising in California. I have no affiliates doing business in California. It's all word of mouth of one customer to another, and it's not done on any kind of a commission basis. And my sales are less than your sales factor threshold. You're probably pretty good. And they'll probably say, okay, you don't have Nexus with us. But the problem that we have with a lot of our smaller clients is, let's say California were to make a stink out of it. It's going to cost you more to fight it than the tax is at issue, right?
which was my CPA's recommendation, was better to pay than be sorry about it.
Yeah, it's if you pay it, you just get in the habit of paying it. You make it a cost of doing business. You make it into, you figure out how to spread the. If you're pretty comfortable, you're gonna be paying that, the minimum assessment every year. You just kind of find a way to bake that into your fees that you charge your California clients and share it, amongst the faithful down there. Then you can make it work. That's probably a safer methodology than running the risk of, well, what do I do if I've never filed there? Then all of a sudden the client of mine says, hey, why don't you come on down? Let's meet. I want to talk to you about this. And let's do it in person because we've never met and you've been my advisor now for 5 years. You're going to say no. You're going to probably want to go. And or it could be your chance to grow your business a little bit. So
Invite them up to Southern Oregon.
Yeah.
Come, we'll go on a wine tour. It'll be great.
yeah, so that's part of the small practitioner's dilemma all the time. But yeah, now that we've gone to market sourcing, it's really a big problem.
Yeah. Okay. Good to know.
So you used a term that I don't know. You said towards the beginning, you said goodwill, and I don't know what that means. I thought maybe it just means schmoozing, but.
Oh, so let's say you've got a client that's selling their business.
Yeah.
And they want to sell for $1 million, and the buyer doesn't want to buy the stock. The buyer wants to buy the assets. And you can say, well, okay, my assets are only worth $100,000, but I'm selling it for $1 million. You're getting my customer list. You're getting my name, my business name. Goodwill basically is a catch-all term for the difference between in an asset sale, the value of the actual hard assets that are purchased and the value that they pay for the business.
Okay.
This came up when Tektronix had a case that went all the way up to the Oregon Supreme Court. And several years ago, Tech sold their color printer division for hundreds of millions of dollars. And I think it was an asset sale. So they allocated something like $450 million to goodwill. And the question was, how do you source the goodwill? And the Oregon Supreme Court said, well, there was no income producing activity associated with goodwill because that's kind of everywhere a business does business. They couldn't, and this is under the old regime for cost of performance, where you looked at the income producing activity for the sale of an intangible. They said, well, there is no specific income producing activity we can isolate to Oregon here. So we're just gonna kick it all out of the sales factor. That's very different than if you are selling a business that, say, operates, the biggest whitewater rafting business, in Southern Oregon may be a pretty big business at the end of the day with a great name, great website, annual customers, who come back every year. They may sell their business for a heck of a lot more money than just the value of their vans and their rafts. They could have a healthy premium. If they do it with an asset sale, the excess of what they sell it for over the value of the vans and the rafts and all the gear, that's goodwill.
Okay, I appreciate that. Thank you.
Sure.
Well, fantastic. Have we gone through all of our questions?
I think so.
Okay. Well, thank you so much, Scott,
Yes,
for
Scott.
for joining us today and for staying late to go through all of our questions. We really appreciate it. And
That is okay. I
I
really enjoyed it. Thanks for the opportunity.
I will definitely be recommending this to our colleagues up in Portland to have you maybe speak with their group as well, because I think that they would really find this information fascinating. So.
Okay. Well, thank you. I appreciate that, and I will take a look out on Facebook for your Facebook page.
Fantastic.
Thanks, Scott.
Have a great
All
day.
right. You too. Thanks, everyone.
Bye-bye.
Thanks. Bye-bye.